Cantabil Retail's quarterly report came out last month for Q4 FY 2025. I am going to go through that. This video is recording of my own research and analysis of the company's past and present financial performance and future capabilities. I am open to any feedback or critique on this. However, under no circumstances should this be construed as financial advice or recommendation of any form. So Cantabil Retail India Limited is listed in Indian stock exchanges. It's in the garment industry. So the total market cap of the company is nearly 22 billion rupees and it has a debt of 4 billion. So the total enterprise value is 25 billion rupees. So the entire company is selling for 25 billion rupees. A billion is 100 crore. So the total enterprise value is 2500 crore and the market cap is 21 or you can say 2200 crore. Now it has a total of 83 million shares outstanding and that doesn't change often. That's a slight change in this year 2024, financial year 2023-24, but it doesn't change often, so that is a good thing. PE ratio is 29 currently, rough figure we can take it as 30, and it has been in this range for a long time. If you see the last 10 years data, it has been in this range. Uh, the minimum was 7 or 8 during this period to 2018 to 2019, and high was this 93 for a short while, but mostly it's been between 45 and 20 on the lower side. So it goes up and down in this range. EVY sales is historically little high. EVY EBITDA is 12, which will give about 8% of return on the enterprise value. And price to book is again about 5, which is slightly expensive, so it has to be a growth company for it to justify this valuation. Now, if you look at the share price itself, it has gone up a lot in last 10 to 15 years. In this range, it was, if we go back about 12 years ago, it was 3.78 and now it is 261 with high of 328. So if you take this 3.2, it has almost gone up 100 times. Now, when share price goes up so much, we have to make sure that revenue per share and profit per share has also gone up to justify the price. Back in 2018, it was trading at about 10 to 20 rupees. Then in 2021, it was 81 rupees. Then it went up to 310, 310. Then it came down to 160. So half of that, it lost 50% of its value in small amount of time. Then it went up to 329. It's been up and down with bottom of about 212 in recent times, and now it is at 268. So Cantabil engages in designing, manufacturing, and branding and retailing apparel and apparel accessories in India. So they design and manufacture their own clothes and then sell it. They have their own stores located in several places in India. I think they have over 600 stores now. The company offers formal and party wear, casuals, ultra casual clothing for men, women, kids under the Cantabil brand name. It manufactures shirts, denim, trousers, business and party wear suits, t-shirts, woolen jackets, pullovers, shorts, leggings, kurtis, undergarment, ties, belts, socks, caps, handkerchief, and accessories. Basically everything which can be sold in a clothing store. The company was incorporated and headquartered in New Delhi. All right. So the total sales of the company is 7 billion compared to the market cap of 22 billion round figure, and net income is 10% of this, which is 748 million. So 10% of sales. So 5 years CAGR of sales is 16%. and it's in this range between 20 and 10% for last about 7 years. EBITDA, okay, in this range it would be between 50 and 20%, and net income CAGR is 35%, which is really good, which is high. So let's check the financial reports now. So we have data for 3 years here, and then we have the graph for 10 years here. So right now, the total sales for the last financial year was 7.2 billion rupees, and this has gone up from 5.5 to 6.1 to 7. But if we take a look at the 10-year data, 10 years ago it was 1.5 billion, so it has almost become 5 times of what it was 10 years ago, right? Yeah, 5 times of what it was 10 years ago. So if you compare this to this 2020 data, it was 3.35, so it has become double of that. Double of this would be 7.7. So next year, if it becomes 7.7, it will be double of this 2022 data. So it's doubling every 4 years or so. Let's take a look at the gross margin. It has consistently been in this range of 70 to 60 to 70%, and it has maintained its gross profit margin. So cost of goods sold (COGS) is about 25 to 30 or 30 to 35% in that range. So it's 5 billion, and then EBITDA is 2 billion. EBITDA margin range. So EBITDA margin has gone up. There's a pattern: goes up, then comes down, then goes up, comes down, goes up, comes down, then goes up, then it will come down. But in total, it has managed to go up every third or so year. So from this year, 1, 2, 3, it went up, then 1, 2, second year it went up, third year it went up again, and then it went down slowly, and then now it has gone up. So round figure EBITDA is going up, but we have to be careful with EBITDA. We don't know what they are depreciating. And then we have net income margin, which has been consistently around 10%. Earlier it was around 3%, so they have been able to improve their net margin, and then they have hold it for last 4 years. And right now, net EPS, earnings per share, is 9 rupees. 9 into 10 is 90, into 3 is 270. So if you check EPS, how much has it gone up? It has gone up a lot. It has actually gone up a lot in last 10 years. If we take this number, which is 0.63, multiplied by 10 is 6.3, so more than 6, almost 15 times. But if you take from this number 2.5, so for last 8 years, it's still more than 3 times, almost 3.5 times. From this year 2022, it has gone up almost double of what it was 4 years ago. So its margin is improving, top line is growing, bottom line is growing, and margins are improving. So it's a good sign. Let's look at this in more detail. Let's take a look at the quarterly number first. There's a 12% growth compared to same quarter last financial year. Last year it had a 14% growth. Before that it had 28% growth. But that could be the effect of COVID. And that could be COVID impact as well. I don't know. So it looks like for them, their Q3 and Q4 are good months. No, Q1 and Q2 are not as good. Because here also you can see Q1 and Q2 doesn't produce the same EPS as in Q3 and Q4. And if I move it in this direction, once again Q1 and Q2 are little depressed compared to Q3 and Q4. Same here, Q1, Q2 are little depressed for 2023 compared to Q3 and Q4. That's the pattern here. They don't make as much money in first quarter and second quarter. So in the first half of the financial year, they don't make as much money, but they make a lot more money in the second half of the financial year. And the revenue is up as well. So revenue went down in Q1, Q2, and that is a pattern. Revenue goes down in Q1, Q2. See, it was thousand. If we take at the total revenues, yeah, so there's a pattern: 2 years down, 2 years up, 2 years down, 2 years up. But it has been continuously growing over a long period of time, over 10 years. It goes up and down for half yearly, but overall it goes up, continues to goes up. Let me go to the income statement. This was just a small snippet of the income statement, as in highlights. If you look at the market cap as well, market cap hasn't gone up a lot. So even in 2022, the company was selling at the same market cap as it is now, but compared to this time 21, it was 7 only 6 billion, and then it all of a sudden it tripled of that amount. So see how it went up from 6.7 billion, it went all the way up to 25 billion. Then it adjusted, came down to 14 billion, and now it's in the range of 21 billion. If you look at the data here for 2017, it was less than a billion, then it went up to 5 billion and then stayed in that range for 2 3 years, and then again it jumped, and since then it has been in that range. And enterprise value follows that pattern as well, so it's not a bad thing. From 8.6 billion it jumped to 27, then 16 on its way down, and now it has fluctuated to 25 billion. That is the overall enterprise value. So what this shows is that the total debt of the company doesn't vary much year to year, which is a good thing. Now if its revenue wouldn't have gone up, only the P ratio would have fallen, then that would not have been a good sign. But because here the P ratio has been consistent, as we saw earlier, and market cap and enterprise value has gone up with the increasing sales of the company and increasing profits. So company has become bigger, it's selling a lot more products, it's earning a lot more money, so it deserves an increase in its share price as well. And cash from operations have gone up as well. We will come to that later. Let me go to the income statement here. So we have our total revenue, which we already saw has gone up. Then we have cost of revenue or cost of goods sold, which has also gone up, but it has only gone up in the last 10 years. If you look at this, it has only become 3.5 times. So the revenue has gone up by 5 times, but the cost of goods sold has only gone up 3.5 times. So that's a good sign. And look at the gross profit, it has continuously gone up. Let's say round figure, if you take 920 million, if we take round figure a billion, it is now 5 billion. So gross profit has again jumped 5 times. What this shows is, so in the future, if their revenue goes up, they will be able to control their costs and their gross profit will go up. So that is the gross profit margin. Let me check this again. Gross profit margin here seems pretty consistent, but it has gone up from 64% to 70%. It will be in this range from 64, let's say 65 to 70%. So with more revenue, it will have a higher gross profit, and this COGS is normally a variable cost. This is normally a variable cost. So if this is high, if the cost of goods sold is high compared to the revenue, then there won't be as much of the gross profit left to spend on other things like SG&A or R&D or depreciation and amortization. So there won't be as much money left for other expenses, and that is not a good sign. Then the net margin would be really low. But when a company has high gross profit margin, that means they have a lot of money left for other expenses, and then they will be able to maintain high net income margin as well. So it's a good sign here. Then if you look at the selling, general and administrative cost, once again, let's say round figure 400 million to, yeah, so it's about 4 times. So while the revenue has gone up 5 times, SG&A has only gone up 4 times, which is again a good sign. What is this as a percentage of total sales? 14 of 70, so it's like 20%. Then 13 of 61, so 14 of 72, it's like 20%. 13 of 61, it's slightly higher than 20%. 10 of 55, it's slightly lower than 20%. So their SG&A expense is in the range of 20%. So let's say of the total revenue they earn, they have about 30 to 35% of COGS, and then about 20% of SG&A. So that comes to be 50 to 55%. So they are still left with 45 to 50% of their total revenue for other expenses, in which they have depreciation and amortization. And I know they lease their stores, so they will have some lease expenses as well. Some a part of that might be included in the depreciation part. We have to check how much of the lease liability they have. But then they have other operating expense. We'll take a look into this, what this is. But after that, they are left with an operating income which has gone up from 92 million to 1.25 billion. Let's say 92 million is round figure 100 million. That's 100 million. So it has become 12 times. Now that is some growth. Even if you look at from 2020 data, from 400 million, it has become thrice of that number. So there's continuous growth in the company, which is a good sign for me. Then they have loans, so they have some net interest which comes out of this, which is about 25% of this data. And this net interest expense has only continuously gone down. Actually, they are paying it, so it has gone up from 43. So this has grown up a lot from 45, double would be 90 into 4, 360. So it has become 8 times of what it was earlier. It's roughly about, if I double this, it will become 700 into 10, so 5%. So this net interest expense is roughly 5% of net revenue. And then what they are left with is this number, which is about 10% as we saw here. Yeah, so they are roughly left with 10% margin. So let's say if the company continues to grow by 16%, and 16% in 5 years, it will only double. All right. So if it doubles its sales to 14 billion in 5 years, and 10% of that is the margin, they are left with 1.4 billion. So this number is actually earnings before tax. This is earnings after tax or net income. So this is 10% of the total revenue. So 700 is roughly 10% of this 7 billion. So it would be 720, and this is 748 here. And similarly, this is 622. This is 10% of 6.2, and here it should be 550. And what we have as net income is actually more than that, more than 10%. That's why you had this increase here. Uh, if you look at the net income margin for this year, it was 12%, but before that, it was 10% as well. So we have our net income as 10%, but if you go up, if you look at this figure, operating income, which is EBIT, earnings before interest and taxes, so that is about 12 by 72, that would be 25 divided by 721, that would be about 17-18%. Similarly, 10 of 60 would be 1 by 6. So 10 divided by 61 is again 16%. 11 divided by 55 is 20%. For this, for financial year 23, the operating income was 20% of the revenue, but since then it has been in the range of 16 or 17%. And then from the interest, once again, we have to see this lease liability is a very complicated thing now. When they take the lease, they don't show lease expense as rent, which should be the right way as per Warren Buffett. What they do is they uh, convert their lease into a liability, and then all of the leased properties are converted as assets, and then they show it as depreciation of the assets for whatever the lease rent they pay per year. They show it as depreciation, and then they show part of that as interest payment on the money, hypothetical money they would have taken for their asset. So it's very complicated. I don't have, I cannot explain it in simple terms. But a part of that interest payment may not just be the financial interest, it could also be the lease interest. So of the overall payment they would do for the lease, a part of that would go as interest and a part of that would go as depreciation. So we'll check that in the quarterly report of the company in a short while. What we have here right now is, if you just take a look at the 3 years data, it will look like their EPS is stagnant. But the moment we take a look at the 10 years data, we see there has been a clear growth in the EPS from 0.67 10 years ago. From 2016 data here, it was 0.6763 something to 8 point. So it's like 12 to 15 times of growth in net EPS for 10 years period. And the dividend is minuscule, it's not much. I think they are using most of the income to bring further growth to the company, so that's a good thing. They are investing all of their income as capex. Once again, we will check that when we go to cash flow, but before that, let me check the quarterly statement. I have their quarterly statement here. So for the entire financial year, they have their 7.2 billion. This is in lakhs, so this would be in millions. So 7.2 billion here, and for the quarter they have this 21. Let's say this is in lakhs, right? So this is 219 crore. Actually, it's easier to read in terms of millions and billions. Millions is 10 lakhs and billion is 100 crore. So if something is 1 billion, that would be 100 crore. This is 6 billion. That means this is 600 crore. This is 7 billion, 7.2 billion. So 720 crores. Similarly, this is 2.1 or 2.2 billion, so 220 crore. So their total sale for the year or for this quarter was 220 crore. They have some other income as well. It could be interest income from FD or whatever they would have done with their cash. We'll look into that if they have given that. I don't think they have given this data here in the quarterly report. But if we check the annual report, their annual report is supposed to come out in August. Last year it came out in August. If you check there, I think this is through the FDs they would have done. So if you compare year on year for the quarter, it has gone up slightly, about 10-12% growth. But for if you check for the year, there is a clear 16-17% growth for the entire year. Then they have their cost of material consumed, purchase of stock in trade, and changes in inventory. If we add all these three, This will give us our total cost of goods sold. And here, if we add these three, this will be 21. So half of this. So about 30% of this, right? 7, 7, 7, 21. So about 30% of this. Similarly, for last year, 8 and 12 is 20. It was 20 here. So in terms of percentage, and company had higher gross profit margin, it went up from 67 to 70. Then they have employee benefit expense. This is SG&A. This is 14. This is about 13. So this is 14. This is not about 13. 12.8. So maybe they have added something else. Then there is finance cost, which is 3.5 and 2.97. So they have their finance cost at 3.5 and 2.9, but they have income coming from somewhere. So that reduces it to 2.8. Then they have their depreciation and amortization, which is 8 and 6 here. 8 and 6 in millions. And then they have other expenses. So I don't think they have given details of the other expenses, but when the annual report comes out, we will have the breakup in that. They have their taxes, and this is profit they are left with. Then some other adjustments to that. These are minor changes, so we won't worry too much about this. Let's check the balance sheet here. So they have a total asset of 9.4 billion, and of that 5.4 is the liability and 3.9 is the equity. So the total equity is just 3.9 or round figure 4 billion, and we have to pay 5 times of more than 5 times of that to buy this company. So the market cap of the company is much higher than its book value, but it is already a settled business. It is doing business round the year and it is growing every year. So in what time will it become 5 times of what it is today? Let's say it will surely become 5 times in 10 years. But can it become 5 times of what it is today in 5 years? Let's check the book value total equity. 10 years ago, it had a book value of roughly 750. So double of 750 is 1530. Yeah, so it's 5 times of what it was. So if you buy it at 21 billion in 10 years from now, if it follows the same thing as what has happened in last 10 years, if it has the same growth, then in 10 years book value of the company could be 5 times of what it is today. It could be the book value will be equal to the market cap, but the growth was slowed in the initial 5 years, and for last 5 years it has become thrice already, more than 3 times. So of this 9.4 billion, 3.3 billion of that is current asset, then 6 billion should be its other non-current or long-term assets, and the total liability is 5.4. The current liability is 1.6 billion. So that is accounts payable, accrued expenses not much, current portion of leases. See, so they have leases, they have to pay for that, and other current liabilities. So total 1.6 billion. Where is that 1.6 billion coming from? They have little amount of cash, then total receivables. They have a lot of inventory, so they will be selling this inventory. So what they have is 2.8 billion, and what they sell in the total year is 7.2 billion. So they have about 5 months of inventory, less than half. So less than 6 months, about 5 months of inventory they already have in their hands. So if they are able to sell this, they will convert that to cash and they would be able to pay their liabilities. The total current liabilities hasn't gone up. I mean, it has gone up 3 times, but it has not exploded in recent times. And their total current assets, if we check that, That is also not exploded. It has gone up. It has become 5 times, and in recent time it has gone up as well. So the current asset is going up, and current liability is not going up as much as the current assets. So the current ratio is more than 1, and it continues to grow higher and higher. So most of the current asset is from inventory. Current asset will normally have these three things. There's inventory, there's cash, and there's receivable. When they sell the inventory, if they sell for credit, they would have receivables, and they have very small amount of receivables, which is a really good thing. So they sell their stuff for cash. They don't sell on credit, they sell on cash, and then they have whatever cash coming in the business. And we'll have to check in the annual report that when they buy, when do they pay their suppliers? Do they have to pay their suppliers upfront, or do they pay later? Because they are selling in cash, so the moment they make a sale, they get the cash. Right. When we go and buy something from the retail stores, we pay them straight away. Even if we are paying from credit card, they would get paid by the bank straight away. Now, when do they pay their suppliers from whom they would be sourcing the textile or the raw materials? So if they are buying on credit and selling on cash, that is a very good business, because after they sell, after they get the cash, they can pay their suppliers. So they won't run out of cash anytime soon. We need to check the annual report for that. And then they have long-term leases. This is for the stores. This has continuously gone up because they are opening more and more stores. So it has become double of what it used to be. On the asset side, they have net property, plant, and equipment. In this property, plant, and equipment, they have their production facility where they make their garments. But I think they are converting all of their lease properties, which they are running as stores, into assets as well. And that would be included in this. Once again, we will need to check the annual report for more details. So I got two things from the balance report. One is the current ratio is more than 1 and it is growing. That is a positive. The second thing I am getting a feel from this report, I may be wrong, is that they pay their suppliers after they sell the final product, after they sell and raise cash, and they use that cash to pay the suppliers here, because accounts payable is higher than accounts receivable. So they are buying on credit and selling on cash. And then when it comes to long term liability, they only have long term leases. They don't have a lot of debt, which is a really good thing. So they are not running on debt. To grow, they don't need more debt. They don't need to raise debt to open more stores. They can just lease the property, and once they make the sale, they can pay from the cash raised by selling their product. And then remaining part is, this is an important part. You check the history for retained earnings. Is it growing? And it has been growing. So it was a negative 10 years ago, and then it became zero, and then ever since then it has been growing. It has grown to 1.72. 5 years ago it was 139, so it's more than 10 times of that now. Retained earnings is what the company retain from their profit after paying dividends and taxes, and its book value has been continuously growing as well. This is on per share basis. From 9 it has become 5 times of what it was earlier. So their total debt and net debt, net debt is total debt minus cash. Yeah, and this debt, most of this debt is lease liability actually. 3.5, and here it says 4.1. So let's check the balance sheet from the from the quarterly report. They have their property, plant, equipment. So they have their property, plant, equipment. Then they have capital work in progress, and they have right of use assets. So see, for this 5.4 billion rupees, which is given here for total net property, plant, and equipment, if you add these three, I think this will roughly become 5.4. So this is in lakh, so this entire thing will become 5.4 billion. So only 13 of that, or 1.3 billion of that, is actual property, plant and equipment. Then they have capital work in progress, that would be raw materials, textiles. I don't know if they have cotton, yarn, fabric, whatever. Then they have right of use. These are the stores which they have leased. Then investment property, it's not much. Intangible assets, again, not much. You have some other financial assets, so it could be FD or whatever, because they will always have some money and they will put that in the bank, right? So they will do FD, or they will invest in bonds somewhere in the open market. Deferred tax assets, net. All right. So this is their this is long-term assets, which we found out to be 6 billion, and they have it 6 billion here. 6 billion because 9.4 billion is the total assets minus current assets 3.4. So that gave 6 billion. Of those 6 billion, majority is this right of use assets. So this is a very asset light company. They are showing their leased properties as assets, but it's not really assets. It's only right of use assets. So they have leased, they have the right to use those as they want. I think they lease it for 10 years or whatever. Again, all of those details are in the annual statement. Then when we come down to current assets, they have inventories. In the financial assets, they have not much of investments. Trade receivable is not very high, which is a good thing. They have cash and cash equivalents, other financial assets, other current assets. So I don't see anything which is raising suspicion that there could be something wrong with the company. That's what I'm trying to find, and I don't see anything wrong here. Then if we go down, their equity has sold to 3.9 billion, as we saw here, 3.9 billion, 3.9. And then they have this lease liability. This is non-current liability, their total lease liability, and then they have their current lease liability. So this is what they have to pay in the next year. That is 5.4 billion. This is not in billion, my bad. This is 466 million, 541 million. So this is in lakh, 10 lakhs. This is 541 million of the 7.2 billion which they have sold. Next year, let's say they are able to have a revenue of 5 point or 7.5 billion. 500 million of that could be going for this lease liability. So that is not bad. Then there are other dues as well. So the total current liability is 1.5 billion, which they would have to pay in the next year. So it's all good here. And then they have their cash flow. Let's go to the cash flow here. So now we have the cash flow statement. They have their net income, cash from operations. They have added the depreciation, then other operating activities. All of these are minuscule amount. The major one is other operating activities. What is other operating activities and why have they added it back? Then they have change in inventories. They will subtract it because they have higher inventory compared to last year by 500. So see their inventory has gone up. Here the increase was 1.3 or 130 million. Now the increase is about 490 million. So they will subtract this 490 million because they don't have this in cash, right? They have converted this extra cash into uh, inventory. So they will subtract the cash from operating activity, but they are added for other operating activities. I want to see what is this expense, 260 million. Then there's change in accounts payable. 108 means they have extra cash, so their accounts payable would have gone down. Has gone up. Yeah, it has gone up because they have extra cash now. If accounts receivable would be this positive number, that means it has gone down. If accounts payable is positive number, that means it has gone up. They have the cash with them, they have to pay somebody. Accounts receivable basically means they have made the sale but they haven't got the cash yet. So this positive number means this has gone down. So last year they were waiting for 224 million to come in. Now they are waiting for only 134 million. So net people have paid about 90 million to them. So in all, the cash from operations is 1.5 billion. This includes this depreciation and amortization. Now they have a capex here. I need a breakup of the capex because if they are spending this money to, so raw material will not be capex if they are spending this money for this. So they have this their property, plant and equipment, right? So if they are spending that money to increase this, which is 487 million, then that is the right use of the capex. But if they are spending that money to sow this, that is not an actual capex. The investment in market securities, this is not much. So it is, as long as this is negative, there's no problem, and it's less than cash from operations. But 487 million. So how much million this is? If we subtract this, let me just quickly subtract this. This is 2000 here, so 200 million. So only 200 million of this 487 million has gone for this property, plant and equipment. The other 287 million has gone somewhere else. And then they have their total debt repaid. I hope they are not. I really want a breakup of that, how they are paying the lease, and if they are showing that lease payment in the income statement, or if they are showing it in the, or directly deducting it from the balance sheet. So their lease is their liability, right? This is their long-term lease, and current portion of lease is half of that. So if you look at for the last year, their total lease amount was 2.8 billion, and 500 million was what they had to pay this year. Mm, 500 million is what they are paying here. Because they haven't issued a lot of debt in the last 10 years, they shouldn't have to pay the debt. And since they are paying this debt here, I think they are showing the lease payment as debt here. Now 600 million is a lot of money. Their net profit before tax was 900 million. So if one third of that goes into payment of their lease, then they are essentially left with nothing. So now I am confused. So net change in cash is, the cash amount has gone down this year. This is the most important figure, free cash flow. Free cash flow per share 12, all right. Free cash flow is they take the cash from operations and subtract this capital expenditure. But then what they are showing as debt payment, is it really debt payment or is it rent in the form of lease? Because this property is never going to become there, right? Let's say if their lease agreement is for 10 years, what happens after 10 years? You would have to make a new lease. So all of the money you are earning by selling the clothes is going as the rent payment in the form of lease. But if I come back here, what is this 262? So my only doubt right now is, where are they showing the lease payments? Are they showing it in the income statement or not? Does this total expenditure, including this operating expense and depreciation, does it include lease payment or not? If they are paying the lease rent from this profit, then they don't really have a profit. If their lease payment is included in these two figures, depreciation and amortization and other operating expense, then they have a profit. Let's check this quarterly report. So this is their profit before tax. They have their depreciation, finance cost comes up to 2.1 billion. Operating profit before working capital changes, and then they have inventory adjustments, receivable, payable, income tax paid. So this is their net cash from operating activities, which is 1.5 billion compared to 1.3 billion for last year, which is given here. So there is consistency in the numbers, and it's growing. Purchase of property, plant and equipment and other intangible assets, including adjustment on account of capital work in progress, capital advances and capital creditors. So that is all right if as long as it doesn't include lease payment, security deposit paid, because you are acquiring assets. That right of use asset is not really an asset. It will expire and it will become zero. Security deposit paid, proceeds from sale of property, plants and equipment, investment in mutual funds. All of this is all right. Proceeds from preferential issue of equity share capital. There is 500 million, but why? Repayments of current borrowings, net finance cost, dividends paid, repayment of lease liability, repayment of lease liability. If you add these two, it will become 600 something. And now this company has gone down the gutter. 508. That 508 is repayment of lease liability. 421 here, actually 681. And repayment of interest on lease liability. So if you add these two, this is 800 million, which is more than the profit they are showing. So here the profit they have shown for the year after tax is profit for the year is 748 million, and the repayment is 800 something million. That's not gonna cut it out. See, if they show it as rent here, if they subtract it as rent they are paying for the rented property, their profit will go down to zero. It will go down gutter. They can never pay me dividend. All of their profit will be going down the lease payment route. So cash at the beginning of the year, it has actually gone down now. They haven't shown the cash at the beginning of the year and at the end of the year, but the net change in cash you can see. Mm, it's only 1 year where they were able to make 334 million, but apart from that, the cash. So what's happening is, see, they have leased these stores, they sell clothes, they have revenue coming in, subtract costs from them, subtract SG&A, they don't have much for R&D, subtract depreciation and whatever they are left with will be EBIT, earnings before interest and taxes. They have to pay some interest, some taxes, and then they are left with a profit. But in this profit, they actually have to pay the lease for the rented stores. And after they have paid that, they are not left with any money. That's why they are not able to pay a lot of dividends here. So let's save this dividend payments was 10%. of the market cap would have been 830 million. 830 million is only 5% of this. So what is the dividend yield? That is 83 million divided by 21830.38%, which is not much. Why will I invest money in this company? Now I have a lot of questions about this company. So at the end of the year, it only has 279 million in cash, and the company is selling for 10 times of that. If you look at the book value, it is selling for 5 times of that. So their book value is round figure 4 billion, and company is selling for 21 billion, so 5 times of that. So now the issue I have is its profit is not real profit. The cash flow, free cash flow, is not as free because they have to pay their lease payment anyway. So if you subtract uh, the lease they had to pay at the end of last year, was current portion of lease was 466. Now they have 541, which they have to pay in the next year, 466 million. If you subtract that, it will come down to half. So it will basically be 6 rupees in free cash flow. So there's no point of looking at the multiples anymore because these are all based on net income, and the net income is not true income of the company. So you can look at the EV by sales and price by sales and EV by EBITDA and all that, price by earnings. All of this is fine, and the enterprise value is fine. But the moment we go to profitability tab, all of these return on assets, return on equity, and return on total capital, all of these are based on net income, which is not the true earning of the company. So if I only invest by looking at the multiples, I would be investing in this company. But now I have serious questions about whether the company will ever be able to make money. Why will I buy it for 21 billion rupees, where my belief was that per year it is earning this much, right? Net profit for the year. It was making 750 million, so quarter of a billion. And as it continues growing, it will grow from 750 million to a billion and higher. And then in certain number of years, I would be able to recover my investment here. But that is not true. Their real profit is much, much, much lower than this, which we only get after subtracting the lease payment. Let's say if you subtract 466 from this, you are left with less than 300 million. How many times do you have to multiply that for it to become 21 billion? A lot of times, at least. Into 7, 300 million into 7 will become 2.1 billion, into 10 into 70. So the real PE ratio will come up to 70, not 30 for this company. So all of these solvency and all of these doesn't make any sense now. Return on invested capital is again based on net operating profit after tax, uh, which doesn't make any sense. Now, I want to check the annual report.